We are setting the macro stage today for March 11th, 2026.
Right, and the focal point of our analysis is this profound structural collision occurring right now.
Exactly. You have advancing United States domestic regulatory clarity for digital assets on one side.
And then on the other, you have this rapidly deteriorating kinetic maritime security environment in the Middle East.
It's a massive dichotomy. Our mission for this deep dive is to analyze the real-time daily data and extract exactly how global institutional capital is utilizing Bitcoin's market microstructure to navigate this specific, unprecedented geopolitical environment.
Because they are actively using it, the data proves that.
Okay, let's unpack this, starting directly with the price action and the capital flow architecture we've seen over the past 24 hours.
Yeah. Looking at the exact microstructural price action between March 10 and the morning of March 11, we observed a highly structured consolidation phase.
Right.
The asset opened the period trading right near the $70,000 baseline. And during that transition from the European session to the high-volume New York Open, algorithmic market makers initiated an upward expansion.
Which pushed the price to a localized intraday peak of exactly $71,800.
Precisely. However, without a definitive macroeconomic catalyst to shatter that really dense resistance bandwidth, the asset executed a highly controlled, methodical retracement.
It went down to an intraday trough of $68,500.
Right. But what's critical there is that it stabilized and closed the period securely near $69,654.
In legacy markets, a failed breakout like that often triggers a cascade of panic selling.
Exactly, but we didn't see that here at all. The immediate aggressive absorption of sell pressure precisely at that $68,500 threshold proves the existence of a mechanical accumulation regime by institutions.
He was completely devoid of derivative liquidation cascades.
Completely devoid. When the price dipped, buyers immediately swooped in. This wasn't retail panic. This was apex fiduciaries systematically using the geopolitical macro noise to lower their aggregate cost basis.
And the structural foundation of that accumulation is directly visible in the capital flow data for the March 10 session.
The numbers are staggering.
They are. The United States Spot Exchange Traded Fund Complex recorded a net positive $246.9 million in aggregate inflows.
Despite all the localized volatility.
Right. And when you detail the breakdown of that figure, BlackRock's IBIT absorbed a massive $186 million independently.
While Fidelity's FBTC secured an additional $33.5 million.
So what is the mechanical implication of those specific figures?
The implication is absolute because of the strict T+1 settlement requirements. These 9-figure daily inflows mandate the physical extraction of the asset from the secondary market.
Right, because when nearly $250 million enters these funds, the issuers are forced to go out and acquire the actual Bitcoin to back those shares.
Exactly, settling the very next day. They are physically extracting BTC from the secondary market. Apex fiduciaries are demonstrably warehousing supply.
Which brings us to the most consequential systemic development onshore. On March 10th, Securities and Exchange Commission Chair Paul Atkins delivered a highly detailed address at the FIA Global Cleared Markets Conference.
Yes, acting directly on the Project Crypto initiative?
Right, which is that collaborative effort with Commodity Futures Trading Commission Chair Michael Selig.
And the mechanics of what they are doing are deeply significant. They are formalizing a memorandum of understanding that implements two massive structural changes.
The first is substituted compliance.
Right. In practical terms, this dictates that Tier 1 banks and broker-dealers registered with one agency satisfy the rules of the other simply by adhering to their primary regulator.
It cuts out the double jeopardy of regulatory red tape.
Exactly. And the second structural change is the creation of a joint consultation platform.
Designed to provide synchronized product approvals.
Yes, which completely bypasses the multi-year agency referrals that previously stifled capital deployment.
Here's where it gets really interesting. Chair Atkins explicitly reiterated support for cross-marketing integration.
This is the absolute critical piece of the puzzle. By mathematically lowering the compliance overhead for major broker-dealers, that administrative green light fundamentally transforms the asset.
It allows massive fiduciaries to utilize their regulated spot Bitcoin ETF holdings to directly collateralize traditional equity options.
Or sovereign bond futures. It means the asset is now integrated into the very plumbing of Wall Street margin accounts. It's a mechanical upgrade.
However, we have to contrast this executive and administrative progress with the ongoing legislative stagnation. The Crypto Clarity Act, formerly designated H.R. 3633, remains completely stalled in the United States Senate.
It's currently the victim of a jurisdictional turf war.
Right, between the Senate Agriculture Committee and the Senate Banking Committee.
The Agriculture Committee is aggressively advocating for CFTC authority, while the Banking Committee is intensely focused on preserving SEC oversight. This internal friction has indefinitely delayed the scheduled markup vote.
We should also note that President Trump has explicitly backed the Crypto Clarity Act, stating his intention to make the United States the dominant force in the global digital asset space. Just to be clear for you listening, we are impartially reporting the political landscape and statements from political figures here strictly as factual data points regarding the regulatory environment. We are not endorsing any political viewpoints or parties.
Absolutely. What is highly revealing, though, is the market's reaction to that legislative impasse. Sophisticated capital deployers are entirely satisfied with the immediate administrative relief provided by the SEC and CFTC.
Because the regulatory agencies themselves have effectively de-risked the ecosystem for institutional entry.
Precisely. They don't necessarily need the legislation to pass immediately if the administrative threat is neutralized.
And that domestic regulatory tailwind is moving entirely against the broader macro horizon. Specifically, when we look at the February Consumer Price Index data released on the morning of March 11.
The CPI data?
Yes. The official data confirmed a 2.4% year-over-year headline inflation rate. Core CPI rose to a 2.5% year-over-year rate. And the energy index itself increased 0.6% during the month.
What's fascinating here is that sophisticated quantitative algorithms view this specific data set as fundamentally obsolete.
Because it completely predates the current Middle Eastern escalation.
Exactly. It entirely fails to capture the systemic macro shock unfolding offshore right now. Looking at February's inflation data in mid-March under these new kinetic conditions is functionally useless for institutional risk managers.
And that offshore shock is defined by the catastrophic breakdown of maritime security at the Strait of Hormuz.
The verified intelligence confirms that 3 separate commercial vessels were struck by projectiles.
Right. Thailand's Miri Nari, which was evacuated due to a massive fire. Tragically, 3 crew members remain missing.
Then you had Japan's One Majesty.
And the Marshall Islands star Gwyneth. Both sustained hull damage.
This brings the total number of commercial ships attacked to 14.
Signaling an indiscriminate blockade.
Yes. And in response, United States Central Command executed preemptive strikes that destroyed 16 Iranian mine layers near the strait.
So what is the hard economic consequence of this specific kinetic dislocation?
It is severe. We are observing the physical closure of a corridor responsible for roughly 20% of global daily crude oil. The physical closure of that choke point guarantees an acute supply-side shock,
which mathematically forces structural inflation directly into the global supply chain.
Regardless of domestic interest rates, that is the key.
Which puts the Federal Reserve in an impossible position.
They are structurally tracked. They cannot tame this mathematically forced inflation without triggering a sovereign debt crisis. There is no monetary policy tool that clears naval mines from a maritime choke point.
And the gravity of that potential sovereign debt crisis is compounded heavily by the rapid expansion of Operation Epic Fury.
The military expansion is accelerating.
During a highly detailed Pentagon briefing, Defense Secretary Pete Hegseth formalized the escalating conflict, declaring that March 10th was the most intense day of strikes.
He confirmed the deployment of strategic B-1 and B-2 bomber fleets,
plus B-1B bombers moving to RAF Fairford in England to increase operational tempo.
Right.
The human toll is also compounding quickly. Approximately 140 United States service members have been wounded in just the initial 10 days.
And during a media briefing, White House Press Secretary Caroline Leavitt explicitly refused to rule out the deployment of United States ground troops,
which forces the market to price in the probability of a protracted ground campaign. We're also seeing unprecedented domestic security measures. Texas Governor Greg Abbott activated the National Guard for Operation Fury Shield to protect energy facilities, ports, and the border.
Washington and New Hampshire guards were also activated.
Again, just to be clear for you listening, we are impartially reporting these domestic security actions and administration statements purely as objective data points regarding the war effort, with zero political endorsement. So what does this all mean?
The macro-fiscal implication is unavoidable here. A capital-intensive war of attrition, combined with mass domestic mobilization, requires explosive, unbudgeted sovereign debt issuance.
The Treasury has to issue massive supply, and the Fed has to monetize it.
Exactly, which permanently debases the fiat architecture. You cannot print your way out of physical constraints without diluting the currency.
And the probability of a diplomatic resolution is heavily diminished by the verified intelligence regarding the Iranian command structure. Supreme leader Ayatollah Ali Khamenei was assassinated on the opening day.
Right, creating a massive leadership void.
His 56-year-old son, Mojtaba Khamenei, took succession, but was reportedly injured in the legs on February 28.
He is sheltering underground.
Yusuf Pezeshkian, the president's son, claimed via telegram that Mojtaba is safe and sound, but the vulnerability is obvious.
If we connect this to the bigger picture, a physically vulnerable supreme leader relies entirely on hardliners to project internal strength.
He is structurally incapable of negotiating a ceasefire.
And he cannot order proxy stand-downs without risking an internal coup. This guarantees a protracted, multi-month macroeconomic disruption.
Which cements the necessity for institutional capital to pivot.
Yes, they must utilize Bitcoin's mathematically verified scarcity as a mandatory survival mechanism against this collapsing maritime security.
Synthesizing this deep dive for you. The asset's current consolidation phase between $69,000 and $70,000 is not retail speculation.
Not at all.
It is a calculated institutional terminal acquisition window functioning perfectly amidst global kinetic chaos and United States regulatory harmonization.
The data proves they are a warehousing supply.
We leave you with this final lingering question to mull over. Is the physical paralysis of global maritime choke points and endless wartime debt issuance renders the traditional 60-40 investment portfolio mathematically obsolete? What is the fate of the global pension system?
It's a critical vulnerability.
When millions of retirees have their wealth trapped in legacy assets that cannot outpace wartime inflation, how long until sovereign governments are forced to allocate to decentralized scarcity simply to keep their pension funds solvent? Thank you for joining us for this deep dive into the day's market and geopolitical intelligence.
Thank you.